Welcome all. This is our second budget session this year. Last year also we did a budget talk with industry leaders. Day before yesterday, the budget was presented by the finance minister. And although the budget speech was little shorter on the direct tax and the indirect tax amendments, but when we saw the fine print, it was quite a lengthy one. It was quite a lengthy one, and a lot of amendments have been made which are impacting the industry and individuals along. So today we are going to have a panel discussion with our panelists which join in from different industries. And also we have the graceful presence of CA Sandeep Agarwal ji with us, who is the NIRC member elect for the term of 2022 to 2025. In the recent elections, which were concluded in December 2021, he has been elected as one of the council members for Northern Region of Institute of Chartered Accountants of India. So welcome, Sandeep ji.
Thank you.
We heartily welcome you to this program and this session.
Thank you, Anshul. Thank you for inviting me in this platform for such a healthy discussion regarding such a recent budget. So welcome all. Welcome to all panelists.
Just a minute, Sandeep ji, just a minute. So let me just also welcome my co-host today, for Nitin Goyal. Nitin Goyal ji is a chartered accountant and also the co-convenor of Let's Share. So just let me brief you about Let's Share. Let's Share is a community of professionals. We have WhatsApp groups, we have Facebook group, and we have also LinkedIn group, wherein more than 700 professionals have collaborated with us. I request you to all to keep please your mics on mute. Participants other than the panelists. So Let's Share is a community of professionals wherein we exchange information about professional updates, professional knowledge, and we try to resolve our collective queries for each other. And that's where we have collaborated a lot in the past. In recent past, we have also started to publish our monthly journal, which was started in October 2021, and 3 editions have already been published. We have seen a lot of participation from authors on varied topics, from GST to income tax, right, to CFO services and transfer pricing. So there are a lot of interesting topics which are covered in our journal, as well as we have our YouTube channel, wherein we bring in a lot of informative webinars. And we also keep on organizing with other organizations like Asian Economic Council, Chamber of Chartered Professionals, Connect Easy from Mumbai. We keep on organizing certificate courses, continuing education programs, which benefit the community as a whole. So with this background of Let's Share community, I also now invite my coordinator with this to this program, Shikha Walecha, to kindly give a brief introduction of the panelists which we have today, and then I'll invite Sandeep ji. Shikha, over to you.
Hi, thank you so for this opportunity. It's an immense pleasure to introduce the panelists. Good evening, everyone. I'm Shikha Walecha, Chartered Accountant by profession and moderator of the today's session. Today, the platform of the lecture has been graced by the industry experts. Today, in the panelists, firstly, we have the Amit Bansal sir. He's a chartered accountant by profession, having experience of more than 15 years in the corporate tax, including international taxation, transfer pricing, mergers and acquisitions. He is currently working as a divisional head in taxation team in leading the tire manufacturing company from past 8 years. We also have in the panelists Sarika Malhotra, having experience of more than 16 years in the field of taxation. She has worked with Big Four and currently is working as an Indian tax manager, handling direct and indirect taxes, transfer pricing, international tax issues for Cargill, Anshul and offshore entities in India. Next, we have in the panelist CA Simpy Rajpal, having experience of more than 12 years, including 6 years with PwC. Now, she's working as a senior manager of Moody's Share Services India, handling direct tax, transfer pricing, GST, and tax accounting. She has encountered the taxation of multiple jurisdictions like India, Nepal, Sri Lanka, Singapore, and many more. Last but not the least, we also have a CA Ashutosh Gupta, who is the tax head at Quest Global. He is carrying experience of more than 12 years in taxation, including the Big Four as well as the corporate world. He has handled all the aspects of taxation, including direct, indirect, and transfer pricing. I really welcome all the panelists for taking out the time from their busy schedule and sharing their point of view on the budget 2022. Thank you so much. Now I would like to give the mic to Anshul sir for continuing the discussion. Thank you.
Thank you, Lord Shikha, for the wonderful introduction to our panelists. I now introduce and invite CA Sandeep Agarwal ji. He needs no introduction. He is a very seasoned professional with almost 1.5 decades of experience behind him. He is also the NIRC member-elect, as I already mentioned, and we are honored to have him on this budget session, and we now invite him to give his take on the budget which was presented a day before yesterday. Sandeep ji, over to you.
Thanks, Anshul. Thanks for inviting in this such a good session. Also, welcome to all panelists who will be sharing his view in this session. Basically, budget just like is a energy booster for the economy, which is मतलब just like एक बहुत बड़ा booster है जो कहीं ना कहीं हमारे एक पर ईयर हमारी इकोनॉमी में एक फीलिंग्स लाती है कि अब इस साल हमारे कंट्री में क्या अचीव हो सकती है. काफ़ी चीज़ें जो एक एक्सपेक्टेशन भी क्रिएट करती है. जस्ट लाइक एज ए पर्सन मैं इंडिविजुअल हूँ तो हमारे टैक्स की क्या स्लैब्स में चेंजेस आती है या जो चीज़ें, तो काफ़ी चीज़ें इफेक्टेड है. इन एज पर इंडस्ट्री वाइज भी काफ़ी ग्रोथ लेवल चीज़ें काफ़ी इफेक्टेड होती है. सो एज पर आवर रिसेंट डाटा हमारी आज की डेट में एज ए इकोनॉमी अराउंड $3.2 ट्रिलियन की है, एंड गवर्नमेंट हैज ए प्लान टू achieve it's at $5 trillion by 2026. So this is such a big achievements. If ये कहीं इस लेवल तक आ जाती है हमारी इकोनॉमी तो ये काफ़ी बड़ी एक अचीवमेंट्स है. फर्दर आज ये एक जो अभी बजट पास हुई है जस्ट रिसेंट 2-3 days बैक, ये एक बहुत बड़ी बजट है. इट्स अराउंड मोर देन $500 बिलियन बजट जो गवर्नमेंट ने डिसाइड किया है जो इसको एज ए एक्सपेंड करने की, जिसमें एक मेजर पार्ट हमारे जो उन्होंने बजट पास किया उसमें सबसे बड़ी एक पार्ट है कैपेक्स की, कैपिटल एक्सपेंडिचर की, जो अराउंड 26-27% है, जो एक बहुत बड़ी डिसीजन है. एंड कहीं ना कहीं एज ए इकोनॉमी कैपिटल एक्सपेंडिचर की बहुत बड़ी हमारे रिक्वायरमेंट्स है, जो चाहे वो इंफ्रास्ट्रक्चर डेवलपमेंट्स हो, बिल्डिंग, हॉस्पिटल्स, मसले काफ़ी चीज़ें हैं जो कहीं ना कहीं एक दूसरे से रिलेटेड है एज ए इकोनॉमी डेवलपमेंट में. और फर्दर डिफेंस में भी एक काफ़ी अच्छी बजट पास उन्होंने किया है अराउंड 5.25 लाख करोड़ की. सो दे आर सच अ बिग डिसीजन टेकन बाय Finance Minister. So, and government takes various initiatives regarding in this budget to achieve the goal. So, for the industry wise, just like there are some industry which are focused in this budget, such just like solar industry. सोलर इंडस्ट्री में भी काफ़ी एक अच्छी बजट अराउंड 19,500 करोड़ की बजट उन्होंने अप्रूव की है, जो आज के डेट में एक बहुत बड़ी इश्यूज है इलेक्ट्रिसिटी कॉस्ट, जो हमारी कहीं ना कहीं सोलर की अगर ये जो डेवलपमेंट्स की बात हो रही है तो उसमें काफ़ी बड़ी एक चेंजेस लाएगी जो हमारी टोटल प्रोडक्शन कॉस्ट पे इम्पैक्ट करेगी। फर्दर ऑटोमोबाइल्स में भी काफ़ी एक बड़ी बजट है, अराउंड 42,500 करोड़ की। फर्दर ड्रोन्स इज गुड इनिशिएटिव्स एज पर माय परसेप्शन, कि काफ़ी उसमें स्कोप्स है आज की डेट में। मैं जस्ट लाइक जैसे डिजिटाइजेशन की बात होती है तो ऐसे ही ड्रोन्स की रोल्स हमारे एग्रीकल्चर प्रोडक्शंस में भी काफ़ी एक इम्पोर्टेंस रोल निभा सकती है, क्योंकि आज के डेट में एक हम अगर एक फार्मर्स के पॉइंट ऑफ व्यू से देखें तो कहीं ना कहीं बहुत एक लिमिटेड सोर्स होते हैं उनके पास कि वो जज कर पाए कि अगर 1 हेक्टेयर की हमारी एक प्रोडक्शन लिमिट है तो उसमें वो जज करना कि हमें कितनी पेस्टिसाइड्स डालनी है, कितने क्या वर्किंग करनी है, कैसे उसकी फार्मिंग की होनी चाहिए। तो ड्रोन्स इज अ वेरी बिग इनिशिएटिव्स टेकन बाय द गवर्नमेंट टू जज, जस्ट लाइक एज पर मैंने जितना पढ़ा या रिसर्च किया उसमें काफ़ी चीज़ें हैं जो पेस्टिसाइड्स की कॉस्ट है वो एक मेजर पार्ट है फॉर द फार्मर्स, एंड विच जो अराउंड 50% रिड्यूस हो सकती है ड्यू टू ड्रोन्स फैसिलिटेशंस। सो फर्दर लैंड आइडेंटिफिकेशंस की भी एक प्रोजेक्ट्स है जो गवर्नमेंट्स लैंड आइडेंटिफिकेशंस करना चाहती है, तो उसमें भी एक बहुत बड़ा रोल्स है। तो ये भी एक बहुत अच्छी इनिशिएटिव्स है। फर्दर डिफेंस में भी काफ़ी जो मैन्युफैक्चरिंग यूनिट्स जो हमारी आज के डेट में मेजर डिफेंस के जो इक्विपमेंट्स हैं जो बाहर से इंपोर्ट होते हैं उसमें भी एक कैपिटल एक्सपेंडिचर के पार्ट में डिफेंस को भी काफ़ी ज़्यादा इम्प्रूव करने के लिए किया गया है बजट। फर्दर एज पर इंफ्रास्ट्रक्चर डेवलपमेंट देर आर सर्टेन अराउंड 25,000 किलोमीटर्स की एक प्रोजेक्ट NHAI की अप्रूव हुई है जिसके अगेंस्ट में बजट पास हो रही है। अब ये एक बहुत बड़ी इंफ्रास्ट्रक्चर इज अ बिग चैलेंज फॉर इन इंडिया, जो अभी तक हम उस लेवल तक नहीं आई है जिस लेवल तक हमारी ये कनेक्टिविटीज यूसूज, जस्ट लाइक एक फार्मर्स को भी अगर हमारी देखा जाए तो कहीं ना कहीं हेलो
Yes, Sandeep ji, please carry on. Please carry on.
तो बेसिकली एक गति शक्ति योजना डिफाइन किया था जो हमारे प्राइम मिनिस्टर ने लास्ट अक्टूबर में। उसमें काफ़ी एक बड़ी एम्स है जो अराउंड 13 मिनिस्ट्री को आपस में जोड़ने की एक प्लेटफॉर्म में लाने की एक इनिशिएशंस है। फर्दर इसमें एक अभी जो बजट पास हुई उसमें करीब 25,000 किलोमीटर्स की जो इंफ्रास्ट्रक्चर रोड्स डेवलपमेंट की आई है। फर्दर इंडस्ट्रियल कॉरिडोर प्रोजेक्ट्स की काफ़ी अप्रूवल्स के लिए हैं कि अराउंड 13 इंडस्ट्रियल कॉरिडोर प्रोजेक्ट्स बिफोर 2025 उन्हें डेवलप करनी है। हिल्स एरिया को भी लेके भी काफ़ी एक अच्छी इनिशिएटिव्स आई है कि उसमें रोपवे प्रोजेक्ट्स वो लॉन्च कर रहे हैं, जिसमें अराउंड 8 रोपवे प्रोजेक्ट्स हैं जो 60 किलोमीटर्स की होगी, जो काफ़ी एक बहुत बड़ी, जिसमें एक PPP मॉडल्स के पे भी ला रहे, जिसमें काफ़ी इंडस्ट्री इन्वॉल्व हो सकती है। तो ये दिस इज ए गुड इनिशिएटिव्स। फर्दर एग्रीकल्चर पॉइंट ऑफ व्यू से देखा जाए तो हमारे एक गवर्नमेंट्स की एम है कि हमारे फार्मर्स की इनकम डबल हो जाए, तो वो उसमें भी एक स्टार्टअप्स के पॉइंट ऑफ व्यू से उन्होंने स्पेशली स्टार्टअप्स को इसमें इंक्लूड किया है फार्मर्स के पॉइंट ऑफ व्यू से। तो जिसमें एक मे भी शायद एक नई पॉलिसी डेवलप करें और उनमें स्टार्टअप्स को एक अलग से बजट अप्रूव करें। ये एक अच्छी इनिशिएशंस होगी जिसमें काफ़ी इंडस्ट्री अब प्रमोट मतलब एग्रीकल्चर में भी जाने की एक जो इनिशिएशन है वो कर सकते हैं। फर्दर जस्ट लाइक नाबार्ड भी आज के डेट में उन्होंने अप्रूव कर दिया कि आप लोन दे सकते हो फार्मर्स को, और इस प्रोजेक्ट्स में काफ़ी जगह पे एक इनिशिएशंस उन्होंने एग्रीकल्चर को भी लिया है। फर्दर टेक्नोलॉजी काफ़ी एक 5G को लेके उनकी एक पॉइंट आउट की गई है। अभी तो हम लोग जो आज के डेट में एक वर्चुअल मीटिंग्स कर रहे हैं, जितने भी चीज़ें कर रहे हैं 4G टेक्नोलॉजी पे कर पा रहे हैं। बिफोर दैट हमारे काफ़ी एक लिमिटेशंस थी। तो 5G आने के बाद ये एक बहुत बड़ी एक मे बी डेवलपमेंट होगी एज ए इंडिया। कहीं ना कहीं जो उनकी एक गति शक्ति योजना जो जोड़ना है 13 मिनिस्ट्री को, तो उसमें भी एक बहुत बड़ा रोल निभाएगी। और काफ़ी चीज़ें हैं जो इस बजट में, और फर्दर इन टर्म्स ऑफ अगर टैक्सेशन, जो हमारा एक आज का इशू हमारे लेट शेयर की एक पर्पज है कि टैक्सेशन में क्या क्या चीज़ें चेंजेज आई है, और बेसिकली तो उसमें एक मे बी फॉर द पर्पज ऑफ इंडिविजुअल्स और फॉर द पर्पज ऑफ टैक्स पर्पज देयर सम लिमिटेड चेंजेज, बट इन टर्म्स ऑफ अगर एक्सपर्ट ओपिनियन लेंगे तो उसमें अभी हम लोगों को काफ़ी चीज़ें मिल जाएंगी जो आगे अभी हमारे पैनलिस्ट जो बैठे हैं उनकी डिस्कशंस में हमें पता चलेगा। एंड सो दैट मेरा आज का यही व्यू है कि दिस इज ए गुड बजट, बट दिस इज ए लॉन्ग टर्म ओरिएंटेड बजट, सो दैट हमारी इकोनॉमी जितनी बढ़ेगी तो हमारे एज ए प्रोफेशनल भी हम लोगों को इसी चीज़ को अप्रिशिएट करना चाहिए कि इस बजट में जो चीज़ें अगर इम्प्रूव होगी एज ए इंडस्ट्री एज ए होल इम्प्रूव होती है तो हम एज ए प्रोफेशनल हम लोगों के लिए भी काफ़ी अच्छी अपॉर्चुनिटीज आएंगी। थैंक्स। थैंक यू अंशुल।
थैंक यू संदीप जी। नितिन जी, नितिन जी आप म्यूट पे हैं।
Thanks Sandeep ji for your brief summary of about the whole budget and setting a positive mood towards the discussion in initial stages itself. It's no doubt it's a long-term vision budget, but as you rightly said, when you get into the details, you come to know that what is there in between the lines. And to discuss that further, I think we have today a good panelist, a good panel who can across the industry represent different kind of industry they are from. So I would like to start with if Mr. Amit Bansal permits me, Mr. Bansal, if you can just throw what do you think about this budget, some areas which you might think.
Yeah, sure, Nitin. So first of all, thank you Anshul and Nitin for inviting me on this platform and giving the opportunity to speak a little bit what I know regarding the budget amendments and taxation. And secondly, I just wanted to mention that whatever I wanted to discuss, or it's only my personal views, and it's nowhere a specific industry related an opinion or something. It's like in a personal capacity, whatever I'm think on the from the industry side, I just wanted to discuss on this platform. So as you mentioned, Nitin, so my take on budget is that this budget on direct tax side is very limited, very limited benefit, if I say, or if not benefit, then maybe some amendment has been done which are more in the favor of department on which some litigations are pending, and SSCs are winning at some court level and high court, and therefore the respective amendment has been done. And as far as industry is concerned, I don't see any positive side or any tax rate reduction, any incentive given. So for me, it's like a neutral budget actually. So I do not take it as a positive budget. I don't take it as a negative budget. It's like a neutral budget. But still, on some of the part of the budget, on the provision, which I think that it will have an impact, I will try to touch upon and take your views. And then if someone has a question, so anyone can ask from me either after the session or during the meeting also. So first of all, that if I come to an individual, because we all are on the same line, we are thinking that what the budget will do for us. So there is actually no change on any of the rates, any slab, anything. And actually a lot of I see a lot of expectations for there to include some amendments in related to some deduction for the individual, to increase the slab rate, to bring in deduction like work from home, as most of the people are doing. And so actually nothing has been done on that part. So it's actually for individual, I don't see anything relief has been given. And for industry side also, except for a one section or two section, I don't see, but still let me try to get into that. So a positive relief for for the new manufacturing company actually which wanted to start up their business. Earlier the time limit or the permission was given till 2023, and now they have extended till 2024, because in the COVID scenario, no one has actually taken more strong decision to start a new manufacturing company or to come up with a new plan. So that has been actually deferred. So it's a positive move, I should say, because government is thinking that new manufacturing company should be set up. But apart from this, one point which actually I missed in reading this budget and all those points is R&D deduction actually. So if you see, there was an R&D benefit available to all the companies actually who are manufacturing or who are doing in-house R&D facilities. And this was available till last year. And industry is actually expecting that a positive sign to be given to the industry to come with the R&D deduction. Now the government, which I see is from last 2-3 years, has a vision that they wanted to reduce the corporate tax rate by bringing company in the new tax regime and then withdrawing exemptions. So that is actually a good side, but I see a lot of companies still have not opted for the lower tax regime, and there are multiple reasons attached with that, which they are not opting. So in a statistic I'm reading today morning, so only 15 or 20% actually have opted for the new regime for the taxation and not all. So one point R&D, because government is always taking more initiative on Make in India concept. So if you are not allowing R&D benefits, so how the Make in India will happen? Because your product, your goods are not, if it's not as comparable to the market or to the worldwide, whatever the benchmark. So means it's very difficult to set up a Make in India concept without giving an R&D incentive. So that is actually a miss I see in this budget, which is there an expectation from the industry as a whole, and it is not given. Secondly, so that's what I mentioned in the opening remarks also, that there was a small loopholes which government think that yes, the tax recovery is coming less due to this reason, and they have implemented that. One is that dividend taxability from a foreign company, which is earlier there was a DDT applicable for a domestic company. So in a way, if I am a company which is receiving a dividend from a private company, from an Indian company actually, so that dividend actually suffer the dividend distribution at the rate of 17 or 18%, and then it is taxable in my hand it is exempt actually. And now now what happened last year, that this dividend has been this dividend distribution tax has been waived off. So now everything is taxable by slab rate. So now a small loophole is there that if I receive a foreign dividend, the tax rate is 15%. So government has come across, and that's it's mentioned that it should be taxable at the normal rate, not a concessional rate of 15%. Second is 14A applicability. So a lot of us as professional or consultant or as an have seen 14A issue or litigation with all of our client, all of our company who are working. So, but I see this 14A applicability. So what amendment has been done here is that if the section that says that if you receive the dividend, then the proportionate expenses need to be disallowed, and some SSCs or some court has held that if in case of accrual of income, the 14A applicability does not come. So now that the whole has been government said that in the case of accrual also you need to do 14A applicability. But my point is that after this dividend taxability has happened last year, so there is no actually case of exempt income as such which I am receiving. So there is maybe specific cases, section 10 exemption if I am giving, that is only for some cases or case to case basis. But generally this 14A litigation is coming for on the dividend income only. And now dividend is taxable. So what I will do with this amendment? So it has nothing to do and unless to settle the litigation of the past year in the favor of department. So this is the actually amendment which I see. And another important amendment which I see from a company perspective is section 194R actually. So 194R is a new Tds provision, and I come to that provision. Before that, I set the context actually what is this section says and what is the applicability and how it is. So there is a section of section 28 subclause 4. So what this says that any benefit or perquisite received by a professional or a businessman need to be taxed, and it's taxable in their hand. And I take a simple example of a company who is so a lot of manufacturing companies are doing on the dealership made model. So no big company is going in the market directly and selling their goods. It's on a dealership basis. So I sell to a dealer, or it's a P2P transaction that I sell to a dealer, and then dealer, if you wanted to buy something, then you go to that dealer and you buy from him. So my scope is only limited to the sale I'm making to the dealer. And then obviously I want my sale to be higher on the higher side. Therefore, I'm giving a lot of incentive and a lot of promotional things to the dealers and to all those agencies. Ideally, this should be taxable in their hand, because earlier also this section was there. Supposedly, I take an example of I have announced a scheme, and let's say if you sell so much of 100 quantity of a specific product, so you will get an iPhone, and he do the target, and I give it an iPhone to him. So ideally, he should take this in income is taxable, but he is not doing that because there is no tracking of that gift which is received by him, or not gift, it's a benefit which is received by him. So now what government is saying that on that amount, you need to do a TDS implication. So what will happen that if I wanted to gift an iPhone, in this example, I'm doing that. So either I need to collect a TDS amount from the dealer, I need to ask him to give me a check for the TDS amount, then I will give you the iPhone, or I need to gross up in my hand. So if I say I need to gross up, let's say cost of a phone is 50,000 and 10% is a tax rate. So ultimately my cost will increase by 10%. And where this cost will sit, this will sit in the P&L account. And why the gross up case is more applicable in this case, because the second person will not know that why TDS has come. He said that you have committed me a certain product, you have to give me, I don't know what TDS and all those things. This compliance need to be done by company, I don't know what about that. So this somehow, as per my view, will increase the compliance. Already a lot of compliance. So TDS and TCS provision one initially were there. If we see the Act 4-year, 5-year back, so only limited sections were there. But now slowly and slowly what government is doing, they wanted to collect more revenue. They wanted to bring the person in the tax regime. So that is actually very welcome step. So the government is taking. But on the hindsight, what it is increasing the compliance on the hand of company. And when the company is doing the compliances, so actually thousands of transactions are happening on a daily basis. And you do a TDS reconciliation at the month end, you reconcile the books, you reconcile the 26 years, then certain queries come, then you are again doing this. So I see a lot of compliance which is increasing from an industry perspective from last 2 years budget, and this year by bringing this section again, and an additional compliance that will bring on to the company. And secondly, what this section will bring in that in the hand of dealer, if I take an example, this amount will be reflected in this 26 years because tax has been deducted by a company and it will be shown. So 147 notice will be issued to them that you are receiving this year. That means you have done in last year also. Let you give the detail. Otherwise, we will take the 133.6 option and ask from the company that you let us know that how much amount of these type of incentive you have given to your dealers or your commission. And secondly, which I see that supposingly, this is a case which I'm using ago. Supposingly, if there are things which I'm not using it, like let's say Anshul as a CA firm, and I as an industry or as an industry person, I wanted to give him the match passes to see the football match or to see the cricket match, and he actually do not go. He said that, sir, I don't have interest in the football or cricket, let it be. I don't want it to go. And then what will happen? In this case, taxability comes, but he has not received the benefit also. So how that will happen? It means once you have given, you have to charge the tax on that, and as simple as that. So this type of implication, and then the calculation, the mechanism, how it will work is a little tricky, I think, because earlier 194Q section has been come, and then 206 was there. Already issues are not settled. Now bringing this section, I think it's little harsh on the company. On the hindsight, what government can do is take a route of specified domestic. So it's like Form 61A, in which I need to report various transactions on which tax is not deductible, like I'm paying a dividend, and which tax is not deductible, or because now it is taxable in the hand of shareholder, so it's not deductible. So it's reported in Form 61A, and then department can see from there. So instead of doing a compliance or shifting the compliance on the company side, because by this way government is getting the revenue also 10% of the per period amount. If they opted for the SFT model, then probably they have not got the revenue. They have the number of transactions, but they don't have revenue. So the easy target is the corporate side, and then the government try to bring these type of TDS provision to bring to increase the compliance for the government. So this is about 194R, which I think is a little harsh on the corporate side. Then some amendment has been clarificative amendment done on section 37, where some cases were there or litigation was there that if any penalty is paid to a not in India but outside India, then whether it's permissible, not permissible, because the section language reads like you have to incur any penalty in India. So this is like clarificated they have to bring in, which is seems to be correct because this is in the harmony of the intention of the government. And then another one is 195 application, which refund application need to be given to the assessing officer. Earlier there was no provision of filing the refund application. Now after this provision you can do so. Then in the second part, and these are small changes which I observe is there. Then I come to the second part, which I see earlier, if you see the budget memorandum and then budget speech or the government intention, which always says that we don't want it to do retrospective amendment. But in this budget, we again see some amendments which are done retrospectively and which are actually should not be done. Means you can do the prospectively. Why you are doing retrospectively and bringing something, how much collection you will do, like education cess and surcharge. Companies are taking claim and some courts have interpreted in different way. Although I also think that it is in the nature of tax and it should not be allowed as a deduction. But yes, if the companies are taking claim, everyone is seeing each other is taking the claim that let us also try. And government wanted to don't wanted to give that. But retrospectively, by doing that, you are somehow means whatever the code, whatever the high courts have decided, you are saying that no, you will not follow it. So what will happen in this situation? Supposingly a case is there before a high court judge or a Supreme Court judge, and he will say that I am giving you a benefit, but I don't know when the retrospective amendment will done after by the government, and these type of benefit will be taken away. So this I think somehow is reducing the trust of the judiciary also, and this should be avoided, these type of amendment. Secondly, I see last year there was a detailed scheme of a faceless assessment which government has announced. So there was a procedure and there was a specific section of passing a draft assessment order. Otherwise, your assessment is set aside or is cost, whatever the court has decided. As companies has taken that view, and then everyone means due to this faceless, we all know how this mechanism has worked in past 1 year. So a lot of companies' cases or orders have been passed without passing a draft order, and the people have reached to the court that this is wrong, and because this court has decided you want to do that or refer back. So these type of things, they have said that no, there is no passing of draft order. Entire scheme we are bringing now, and there is no need of passing draft order. We will pass a final order. So okay, this is I think more a clarificatory type of faceless. They have again changed this. And then I see one change which is made in section 263 amendment, which they are saying that TP order can be done now in the 263. And this is a effect. If you read the memorandum, if you read the final bill, it says effective from 1st April 22. If that means that before that it is not there, so it is someone can take a stand now that TP addition or TP adjustment cannot be done under 263 route before 1st April 22, because you have clarified that is effective from 1st. So this type of thing again will bring, I think, more litigation. And then one interesting point which I see in the budget is that repeated appeal has been stopped by the department, saying that if a same question of law is pending before the high courts or other court, then you principal CIT or CITs can stay there. But my point, I'm thinking on the practical side, what will happen that once you have a assessment order, now the draft order will also not pass. You will have a final assessment order. Once you have an order in hand, you have to pay a 20% demand before reaching the commissioner, and you have to file appeal, let's say, within 30 days. So assessing officer will ask for after 30 days, he will come back to you and he will say that if you don't pay the demand, I will attach your bank or I will do the recovery proceeding against you. In that case, we have to pay 20%. So there is no mention of that repeated appeals. Your stay amount of 20% will also be stayed. I think that should be done, because earlier there was a concept of like a protective assessment. So if you can do a protective assessment, there should be like these type of assessment, an abeyance assessment, where they are keeping the demand in abeyance and let us wait for the high courts or the Supreme Court to decide on the issue, on legal issue, and then we will collect. and you can collect with interest from the assessee. There is no bar in that. But once you pay 20%, my 20% in tax is on. I don't know what the addition will happen, not happen, and at least that money is blocked. So that is, I think, miss, or I should say, government has not think on that perspective. So if that can be taken care through some appeal to the government to rethink on this provision, so that would be helpful for the industry as such. And then faceless ITT, DRP, and transfer pricing order has been deferred for some time. That is okay because the system is not fully equipped, so they have done that. But other than that, I see small changes, so I will not go into that. And on my final take on the budget side, I will say that it is a more compliance increasing budget for the company, more bringing the Tds provision for the company, and less giving the relaxation or the expectation which was there to the industry and to the company. So Anshul, this is my thoughts on the budget, and you can take it from here.
Great thoughts. I think you have brought out a lot of challenges which the industry is facing right now. There's one query, I think, from Rajagopalan to you. This is, in your example, new TDS provision will apply to gift or compliment which is given. I think you had mentioned that if a complimentary ticket is given and he doesn't go out ultimately, then TDS might still apply. So he's saying that if he doesn't accept, then why should TDS apply?
No, if he doesn't accept, means there is a thin line of accepting or not accepting. Once you have the gift coupon, it may be lying in your cupboard, and you at the last moment you change your plan that I don't want it to go. And then what will happen? If you don't accept, that means no benefit actually has been passed. But if the benefit has been passed to you and you have not utilized it, so who will prove that? So I think these points will come. Means these are gray areas, which I also think that how these things will be taken care, and these will come. These are practical things which will come.
Right. So basically what Amit is saying is that once the pass was given, but ultimately on the day of match or on the day of that particular event, the person decided not to go due to some reasons, might be personal reasons, might be some other reasons. At that point of time, what will happen is that he has not availed the benefit, although the benefit was passed on by the corporate to the individual or the dealer or somebody else, but the actual benefit was not utilized. In those particular scenarios, the TDS will still apply. That's what Amit is trying to say. Right. So Manish Joshi has a question on 14A disallowance. Let's bring in other panelists, Nitin ji, and then once we discuss this particular amendment, we'll have these queries also.
Yeah, I think that would be great. And thanks, Amit. You have very summarily discussed the impact which you think that no doubt the budget has lots of clarifications, but the clarification and overall budget, as you rightly said, seems to be one-sided. That your foreign expenditure liability for penalties or made for the foreign laws will be disallowed, your set-off will be disallowed, your 14A will be disallowed. Basically, clarifications are there, no doubt, but they all are on a one-sided basis. There is nothing in which SSC is gaining except just a certainty that going forward, all these won't be allowed. So don't make any claim on these kind of stuff. That's it. So within this note, I would like to invite Sarika for her personal views, what she thinks about this budget and what she thinks that areas which is a concern for Sarika, over to you.
Just to mention one thing, that the views of all the panelists are their personal views and they do not represent the views of their organizations, just to get the record clear. So we just wanted to mention it. Welcome, Sarika.
Thank you, Anshul, and thank you, Nitin, for inviting me and giving me an opportunity to share my thoughts. As you rightly said, these are personal views, so I will not comment on that again. Coming to what I feel about the budget is that in my personal view, it looks more inclined towards the revenue, as Amit also has mentioned, than the taxpayer, I would say. Maybe to start with, on the proposal of Section 68, which now requires that the person who has availed loan or borrowings would need to justify the source of loan borrowing, and in turn the creditor would also require to justify the nature and source of that source. If we talk about the startups and the new companies, which our government is all encouraging always, this might not be the thought. Like this might discourage investments in terms of these loans, etc. Because the investor would now here in this case need to justify its source from where he got the money, which he is investing in those startups. So this proposal somehow, to my mind, is not aligned to the government's endeavor to encourage the startups. And for industry-wide earlier regarding Section 68, the issue was only limited to security premium, etc. But now this will again start for the loans and borrowings as well. Also, if we read Section 68, the moot point here is that the assessing officer has to be satisfied. Now, whatever valuation you do, whatever documents you show, besides those evaluations, etc., it's important that the AO needs to be satisfied, which is a very subjective aspect. And as a taxpayer, we all know this part, becomes very tricky to comply with sometimes. Further, the proposal regarding updation of returns, as the tax budget was started with this point only. Basically, it provided that an extended time of 12 months and 24 months, so to say, is given to an assessee to update or rectify its tax return, which comes with an additional cost of 25% or 50% if you file it within 12 months or 24 months. As appears, this proposal can benefit those taxpayers who have basically failed or omitted to include certain incomes in their original tax return, and realizes it post the dates of belated and revised returns have also lapsed. On the contrary, absent this provision, when this provision was not there, if the AO finds out this income during the assessment, then there are penalty provisions along with interest and tax, which we all know. Now, regular tax and interest is a neutral factor in both the scenarios. So essentially, to my mind, it's a kind of a trade-off between additional tax of 25 or 50% on one side and the penalty on the other to take a call whether a updation would be done by the assessee or not. Somehow it looked to me like a mini version of what settlement commission was there, which used to be, which could have opted once in a lifetime of the assessee, but in this case it can be opted once for a financial year or an assessment year. Also, this updation, which can be done, includes certain situations where department is going to get benefit, like the taxpayer cannot update the return in a case of loss return, or where the refund is increased, or where the liability is decreased. So, for example, if there is a genuine case that the assessee realizes post the belated and revised return dates have gone, that he had to make an additional claim, then he doesn't have this option, and he will have to undergo with the normal route of making an additional claim before the AO or CIT appeal. And in those cases, is not going to receive any additional interest, so to say, from the tax department. So to my mind, it's a little one-sided. Also, there was a significant amendment, I would say, on the virtual digital asset side. Although up till now, I think in the tax act, we were not recognizing this at all as any asset. But now I think because the transactions are increasing day by day, it's another fact whether it is, what are the regulations regarding it, or it is legal or not, that's another debate. But from tax perspective, I think what they have proposed is that they are inserting 115 BBH to enable the tax to tax the gain which is derived on the transfer of these virtual digital assets at the rate of 30%. Also, it's been provided that no loss on transfer of VDA will be allowed to be set off against any income under any of the provisions of the Act, and neither will this loss be allowed to be carried forward. So I feel there could be some open questions here, whether the loss on these assets be allowed to be set off against the income of these assets itself, like the loss on VDA be allowed to be set off against the income of VDA, whether the gain, so is it a capital asset? So suppose a company or a person is deriving gains from a regular trading of these assets, will that be taxable as PGBP? So those things are still need some clarity. And there are around, there are some peculiarities on quantifying the amount on which, so they have also included the TDS provision, which they have inserted through section 194S. This has its own peculiar problems, how to quantify the amount on which TDS needs to be deducted, especially in view of the fact if there is a consideration which involves in kind also, and not necessarily in cash. So I feel there could be, these some of the open questions which it brings along with it. Besides this, I think another significant amendment which may impact some of the companies or those companies who have subsidiaries outside India is the abolition of section 115 BBD, which basically used to provide a concessional tax rate of 15% on the dividends which are received by an Indian company from a foreign company. So there are conditions that you have to have 26% shareholding in that company and other few conditions. This basically would mean that the dividend will be taxed as a regular other sources income in the hands of recipient. This is, I think, certainly going to impact a lot of Indian companies who have subsidiaries outside India, and will sort of discourage, I feel, the remittance of dividends into India. Although the budget said that this has been proposed to be made in line with what they have done post abolition of DDT to have a level playing field. But if you notice that the section was inserted initially with an intent to give a concessional rate of tax to these offshore dividends. So when it was inserted in Finance Act 2011, and this was again extended in 2012, they had clearly mentioned that in the memorandum that they are, inserting this or they are bringing this section as an incentive for attracting repatriation of income earned by residents from investments made abroad. Now, I think post-abolition, the incentivizing aspect will be diluted. So though they have made it at par with the normal dividend also, which is to be received from the Indian company only, but the incentivizing aspect no more remains here. Also, I think there's a substantial amendment on the section 148 and 149 side. There was a huge revamp of these sections that happened in 2021 budget only last year, and which had made it a little more taxpayers friendly, I would say. But now seeing the amendments this year, it looked that whatever relief they had given earlier has been taken back by the department. So I think last year we all know that, the section was amended and there was a whole 148 was substituted with new language, and 148A was introduced for procedural, which provided the procedure as to which needs to be followed by the tax department if they want to issue a 148 notice. One of the major changes at that time, which was given as a relief, was the time period for issuance of notice under section 148. So they had reduced it from the outer limit of 6 years to 3 years for a normal case, and they had increased the period to 10 years in cases where the income chargeable to tax is represented in the form of an asset. That's the language that they use. And the income escaping assessment should have exceeded the amount of 50 lakh. So by and large, the limitation period for industry-wide was 3 years, because 10 years was applicable to companies where they have created an asset, and because of which the assessing officer has opened the assessment. Now, by this budget, I think they've increased the scope of 10 years by inserting that the cases which can get opened within the 10 years would also include the cases wherein the income chargeable to tax is represented in the form of asset plus expenditure in relation to a transaction for an event or occasion, or any entry or entries in the books of accounts. Now, it's quite a wide scope for a 10-year limitation period. This effectively would mean that any case now can get opened within 10 years period, because entry in the books of accounts can be either on site. So thus, I feel the so-called relief which was given last year by reducing the time limit has again been taken away this year by bringing it back to the 10 years timeline. Also, in the same section, I think they've enlarged the scope for issuance of 148 notice. Earlier, the 148A was inserted, which provided a lot of compliance on the part of assessing officer, and he should have given a he required a prior approval of specified authority even before issuing a notice and passing an order that why I needed to issue a notice, and there were at 3 level there were compliances required, whereas they have now made it at a level 1. That they have said that it's a clarificatory thing in nature. Also, I think the last year they had made an amendment which said that the information on which on the basis of which the AO could have issued 148 notice had included a fact that the objection has been received by a controller, auditor in general of India. So basically C and AG audit would have revealed something about the assessee, and this fact came to the notice of assessing officer, which made it possible, or which made it liable for issuance of those notice. Now they have further reduced it. So CAG audit reasoning was more authentic and procedure driven requirement. However, now they have made it to include any audit objection and any information under section 90 or 90A, or any information which requires action in consequence of the order of tribunal or court, thus making it too wide for them to issue 148 notice. So I feel what all they had brought in last year, they had just made the opposite of all the provisions this year, barring few of the things like search and seizure and other procedural things were included in 148, which now also remained. And lastly, I think a lot of companies, and I would tell you our company was actually expecting much needed clarifications on the equalization levy, which has not sadly come at all. Because one of the concerns regarding EL is that the current language of the section appears to include in its ambit all the transactions, all the purchase orders, invoices, which are just exchanged through online medium or emails. The way they have defined an e-commerce operator or online sale of goods and online provision of services, also, I don't feel that those definitions align with the intent which was there when the EL was first introduced, White Finance Act 2016, and then followed by 2020. Because, they came or were introduced as a follow-up measure of BEPS action plan to basically capture those digital companies or the companies who are working as a typical e-commerce operator. But the intent was never to cover the hardcore companies who are running plants and manufacturing divisions and dealing in hard goods. So I feel the intent of EL was, to bring in its scope the digital operated companies like Amazon, Flipkarts, and other similar companies who totally operate on digital online modes. Because, in practical world, if you see, there'll be no single company who would not be using email or online portals for its day-to-day operations. And the way EL is drafted currently, it seems to apply to all of them, which is obviously should not be the intent. So I think much needed clarifications were required on this, which unfortunately did not come in this budget. Yeah, so that's what we were feeling from the budget side. These are some of my views.
Yeah, that's great, Sarika. That again, things are getting on that table, other side of table only, that they have clarified, but in the favor of tax office, or you can say that revenue department. The reason might be, although they, on one side, they want to expand the tax base, and on the other side, and I think to achieve that objective, they are just increasing the powers of their officers to do these kind of issuance of notices or the assessments. I think updated return is also a part of that for that objective. And similarly, when we are saying the section 68 and the TDS requirement for this 194R and everything, so they want to increase the tax base, and for getting that objective, what I can sense from you guys that they are giving powers to their officers and giving burden on the industry or the business to make things. so that they can get to know that who all are getting money on that kind of stuff. And rightly said, startups may get a hit on this when it comes to Section 68. Although they may not be every time on the position to do a KYC for their investors, that rigorous KYC or due diligence, I must say, that how they are generating income who are getting investing in that. Yeah. Thanks, Sarika.
And another issue is that when the assessment happens, the startups are not able to get the information from their investors or the persons who have, say, for example, a lot of startups issue nowadays CCDs, convertible debentures. So earlier that was not covered as part of 68, or even means, Section 56 was also favorably amended to exclude registered startups. But now with the extent of saying that you need to prove the source, right? That is going to be a huge burden on the startups or the smaller industries to comply with during the assessment proceedings. So that is one thing. And also, Sarika correctly mentioned that equalization levy is a pain point as of now, because any company which is operating on an internal ERP, which is placing orders on their foreign companies to get raw materials or any other kind of products, those kind of things are also getting covered in the present. Means it seems that it gets covered under the present definition of the e-commerce as it is defined in the Act. So as Sarika mentioned, this was not the intent, but let's see how the officers will implement it on the ground. Nitinji, over.
Yeah, thanks, Anshul. Now, I would like to hear from Ms. Simpy Rajpal, what her personal take on this budget and what's the point she thinks that worth discussing.
Yeah, thanks, Nitin, thanks, Anshul, for providing this opportunity. And yes, as rightly said, these are the personal views and not the views of the organization or the company in which we are working in. So my personal view about this union budget 2022 is that it is having a mixed bundle of proposals. So few proposals seems to be in favor of the taxpayer, but yes, there are other proposals which are more of the revenue-driven proposals. And in addition to this, I've seen that there in this budget, there have been number of clarifications which have been introduced and which is giving rise to some long pending litigation. So as Sarika has also touched upon on the updated return. So this updated return has been introduced, and the wordings which the memorandum says that it is promoting the voluntary tax compliance and reducing the tax litigation. So already we are having 139.1, which talks about the returns, and then 139.4 and 5 about the belated returns and the revised returns. And it is giving time to the taxpayer, some additional time to the taxpayer to file the returns or to correct the omissions. But when it comes to the updated return, it talks about that there has been some additional time which has been given to the taxpayer. And along with this, there has been the introduction of Section 140B, which talks about the interest that will be levied, the additional tax that needs to be paid along with the filing of this return. So basically, on prima facie, it seems like that the additional time has been given to the taxpayer. But if we see, then the other view of it could be that in addition to the extra time given to the taxpayer, there has been an additional onus on the taxpayer as well, because now they have under a responsibility to voluntarily disclose their income, and an additional time has been given to them. Moreover, IT department is having much information which is available to them. So this also gives adequate time to the department to look into that information and to evaluate that what all additional details are to be sorted out. So it is a good position for the department, and at the same time, it is sought to be taxpayer friendly in my view, giving additional time, but at the same time, it is having additional onus on the taxpayer as well. So that's one amendment which came up, and accordingly, it has amended other sections also, like the section of defective return has been amended to an extent to give effect to the provision of updated return, to give effect to this particular section of updated return. I want to take you through some other this budget, like one important clarification on cess and surcharge. So if we relate back to the provisions of section 48.2, which provides that any sum paid on account of rate or tax levied on profit on gains on business and profession shall not be allowed as a deduction. Now, the term was rate or tax. So there has been various judgments which was, just working upon that what is this word rate? Does it include surcharge and cess, or doesn't, or whether it's don't include? And even the industries have been taking different view. Like if we go back and look to the judgment of Sessa Goa or Tumble Fertilizers, then it was held that education cess can be claimed as an allowable deduction. While if we go back to the judgment of ITAT Kolkata, which also focused upon the K. Srinivasan judgment, wherein the moot question that was discussed was whether education cess is a part of, or whether surcharge, I could say, is a part of the word income tax. And that was very well debated in that judgment. And the apex court came with the point that this surcharge or the additional surcharge is a part of the income tax. And after that, education cess came into. So post that, there was number of things which came up. Also, the clarifications came up which define that even the cess and surcharge will be the part of income tax. Now, in order to make the intention of law very clear, the legislation very clear, and to avoid any misinterpretation, it is very clearly proposed in the union budget that the explanation retrospectively. So it is very clear that it is a retrospective amendment, and it is clarified that for the purpose of 48.2, the term tax should be deemed to have always included surcharge and cess. So it leaves no room of doubt that whether surcharge and cess will be covered in the word tax or not, because this budget proposal has made it very clear that it will be covered under the definition of tax. Similarly, there is another clarification which came up regarding the deduction of payment of interest. Section 43B, which talks about that certain deductions will be allowed only on actual payment basis. Now, what the industry was, in some cases it was, there has been various views against in the industry, but the one of the view that came up into various litigations also, that in case there is some interest payable and that has been converted into debenture, or that has been converted into some other instrument, then will that be construed as the actual payment, and will that be allowed as a deduction under 43B? Again, various views. One of the view was that yes, it could be taken as the actual payment, but now this proposal has very clearly clarified that conversion of interest payable into debenture or into any other instrument shall not be construed as an actual payment, and thus that will not be eligible for deduction. Now, if I say regarding these two clarifications which I have just discussed, these are the clarifications, but it has given rise to various important litigations and various different views that was taken up by the industry. And that's why I could say that this year budget is not only introducing new changes, but also giving clarifications, which is restricting much of the litigation. There were some, these were some intakes on the direct tax part. I would also like to touch upon on the indirect tax portion, that's the GST. GST came up in 2017, July 2017, and post that there had been various circulars, various notifications, clarifications, FAQs which came up. This year budget, it give ease to the taxpayer, but yes, there has been certain amendments in this year budget, which is a matter of deliberation and discussion within the industry also. To start with GST, I will first and foremost want to take with the most important amendment in my view, is relating with the section 38, sorry, wherein the language has been substituted, which is having a big impact on the input tax credit availment. So there is section 16.2, which talks about the conditions that how to avail the input tax credit. And one of the condition was that ITC is to be availed through GSTR 2B. That is a condition, a clause AA was added in 16.2, which mentions that credit as mentioned in 2B can be taken. Now, with this proposed amendment in section 38, it has divided GSTR 2B into two parts. One is the available credit and the second is the restricted credit. So the credit, the ITC that...
Clarity and consistency. It can't be that...
Okay, so yeah, so it has divided GSTR 2B into two parts. One is available credit and second is the restricted credit. So the credit which is available in 2B to the extent of available credit, only that credit can be taken as the ITC availment. Now, when we say what is restricted credit, even this restricted credit has been defined, has been, discussed well in this budget, and it is moreover the supplier based credit. That is, if the supplier does any default, then the credit will be restricted. And then there has been 6 categories which has been prescribed therein, that if it is falling under these 6 credit categories, then it will be treated as a supplier is in default, and accordingly the credit will be coming under restricted credit and the purchaser won't be able to take that credit. For example, the newly registered taxpayer. This is one of the category which has been specified, but what is the threshold of being a newly registered 5 months, 6 months, and year? That time limit has not been specified. So probably in the coming notifications, we can have some more details on it. Similarly, defaulted taxpayers, like if the suppliers has not paid their GST, then they will be taken as the defaulted taxpayers. So if we have purchased from a supplier who has not paid GST, then that credit will be shown as a restricted credit in 2B and the purchaser will not be able to take the benefit of that. Similarly, GSTR 1 liability. If that liability is more than 3B, that is what I'm showing, what supplier is showing in GSTR 1 is more than what tax they have paid in GSTR 3B, then again, that will be treated as a default on the supplier and it will be coming as a restricted credit. Another one is ITC availed if it is more in 2B. And then if the provisions of 4912 has not been met or such other conditions as been prescribed. So in detail, they have laid more onus that in case these all conditions have been met, then the supplier will be treated as a defaulted supplier. The credit will be coming as a restricted credit under GSTR 2B. So that credit the purchaser won't be able to take. And if I relate this amendment, this substitution with section 16.2, so if we look to section 16.2, then it was specifying 4 conditions wherein the ITC can be availed. So that invoice or debit note should be there, goods and services to be received, supplier has submitted the return and supplier has paid the tax. So originally these 4 conditions were there, but then AA was introduced, clause AA, which added one more condition that the credit has to be there in GSTR 2B and whatever credit in 2B, that credit you can take. Now with this proposal, there has been another condition which has been inserted by the insertion of clause BA, which talks about that to the that the credit which has been restricted credit under 2B that cannot be taken. So with this, I could say that there has been more on the restrictions which has been imposed on input tax credit, and the government is really focused more upon this. The registered person is entitled to take only that input tax credit which is clear. If there is any doubt in that, if the supplier is having any default, then the purchaser has to bear the brunt of it, and then the purchaser won't be able to take the input tax credit. So this is one of the key change that has came up into this, and probably in the coming GSTRs 2B that will be downloading it now, we will be seeing it under two buckets. One is the available credit, and second is the restricted credit. And only to the extent of the available credit that the purchaser will be able to take the benefit of. So I could say that as of now, it seems to be a pretty tricky provision because it is giving more restrictions on the purchaser to avail the ITC. So the implications of this is that there will be, more restrictions on the ITC availment, and then we can see more, clear ITC that will be seen in the future. Other changes that have been done in GSTR is I'll be covering few changes in one particular point, that is the extension of timeline. So wherever there was 30th September, that has been changed to 30th November. And then the key impact or the major area where I could see the change is section 16.4, because 16.4 talks about the time limit to avail ITC of one financial year in the September return of the next financial year. So earlier, this time limit was linked to the September's month return in the next financial year. But now with this proposal, what has been done, that this timeline of claiming ITC under 16.4 has been extended to 30th November of the succeeding financial year. So there is no linkage to the due date of filing any return. And I could see that this is one of the good change, and it's from the tax perspective from two views, because one could be that the expression which has been used prior was linked with the due date of filing the return. So people were confused that if we are talking about the due date of September's month return of the next financial year, then will it be 20th October or will it be end of September? But now those all things have been put to rest. They are saying that, okay, 30th November of the next financial year is the time period up to which you can claim the ITC of the previous year. The other important thing is that in case you have not filed the September's month return within the due date, then it won't be possible to claim the ITC of the previous financial year. But now it is 30th November, so I could say that that provision seems to be a relaxing provision as far as the taxpayers are concerned. Other than this, the time limit for issuing credit note under 34.2, rectifying errors of GSTR 1, 3B, and also time limit for 52.6 has been extended to 30th November of the succeeding financial year against September, which was mentioned earlier. So there have been the relaxation, I could say, in the timelines, which seems to be taxpayer friendly. So these all things I could say that these are taxpayer friendly. Apart from this, there is one more important amendment of 53, which is a retrospective amendment, and this is a very important taxpayer friendly amendment in my view, because 50 subsection 3 talks about the interest on ITC wrongly availed. So earlier, in case the ITC has been wrongly availed, then there used to be the interest levied on that. But now with this proposed amendment, the interest will be levied only if the ITC has been wrongly availed, plus it has been utilized also. So in case an assessee has availed the ITC wrongly, but it has not utilized that, then in that case, the interest won't be levied. So that seems to be a good change as far as the taxpayer perspective is concerned. And moreover, it is a retrospective amendment. So it is effective from 1st July 2017. So again, it benefits the taxpayers. And then basically there has been, lot many litigations on this portion. So this amendment will end up all those litigations now. And also there was the rate interest, that how much interest will be levied. So till now the interpretation was that the rate interest, that the interest rate will be 24%, which will be levied. But now it has been clarified that the rate will be, interest rate will be 18%. So with this proposal of union budget, it is clarifying that in case the ITC is wrongly availed as well as utilized, then the interest will be levied and the interest will be at the rate of 18%. So again, this turns to be a favorable amendment for the taxpayers as far as the GST is concerned. I would like to also cover, I could say 49 section, which talks about the transfer of amount available in electronic cash ledgers. So again, it seems to be a good change which has been introduced in GST and which talks about that, which allows that transfer in case there is any amount which is available in the electronic cash ledger of the registered person. So it has to be electronic cash ledger. I'm not talking about electronic credit ledger. In case there is any amount which is available in the electronic cash ledger of the registered person, then that balance can be transferred to a distinct person. When I say distinct person, it means that the other GSTIN which is registered on the same PAN, but that can only be transferred if the liability is paid and the balance is left. So if that particular GSTIN has finished up all its liabilities, met all its liability, and still there is some balance which is left in electronic cash ledger, then they can transfer to the distinct person. If I look from the industry perspective, again, it seems to be a good move because now you'll be able to transfer that balance to the other GSTIN number within the same PAN. There have been few procedural changes also which has been done in GST, like in section 47, they have applied for the late fees. For the non-resident taxable person, they have changed with the due dates. So for GSTR 1, they have said for the sequential filing, which is very important, that now there has to be the sequential filing of GSTR 1 is mandatory. If we have not filed the return, let's say for the month of October, then we won't be able to file for the month of November because that has to be a sequential filing. And also, precedent to the filing of GSTR 3B. So again, it becomes very important from the compliance perspective that GSTR 1 has to be filed. There has been few sections which has been omitted also, which is again, I could say a good move because it do away with the two-way communication process in the return filing system, which is again a good move. And another important thing which this budget has done for the GST perspective is, I could say that some of the corrective measures has also been taken, like for section 29. So section 29, it talks about for the GST registration cancellations time limit. When I say the time limit, let's say for a composition dealer, if I take an example, the composition dealer has to file the quarterly returns originally. Then from financial year 1920, the periodicity was annual returns. So though it was changed to filing of the annual returns, but the corresponding section for cancellation of registration in the case of composition dealers was not changed. So that wordings was still that in case returns for 3 consecutive periods has not been filed, then the GST registration of the composition dealers will be cancelled. But since the filing periodicity is annually, so that's why the point was that the amendment needs to be made, the corrective amendment, I could say, is to be made in the corresponding section. So then through this budget, the corrective amendment has been made, and that phase of return for 3 consecutive period was replaced with return for financial year beyond 3 months of the due date of the return. So now it has been prescribed to 3 months of the due date of the return. And for other than composition dealers, again, they have changed the threshold and they have mentioned that continuous period, like as may be prescribed. So that is yet to be prescribed. So I could say that nutshell, these all GST amendments is to be clarificatory. They are taxpayer friendly. However, the major amendment is of section 38, which is a substituted section. So BA, I could say, is a very important change, and which is for the industry. And this I could say is my take and my interpretation of the amendments from the corporate tax perspective, couple of it, and from the GST perspective. Over to you, Nitin.
Yeah. Thanks, Simpy, for making it as explainable, or you can say, I should say that easily explain all the GST stuff as well. And what I feel that the GST amendment has a kind of some positive side to it, rather one-sided as we are seeing in a direct tax regime. So that's great. May I now ask Ashutosh Gupta to share his views on the budget?
Thanks, Nitin. Thanks, Anshul. Thanks for inviting me here and giving me the opportunity to express my views here on this forum. Just as Simpy has mentioned about the GST part, so from my perspective, I just take care of GST of around 18 countries worldwide. And the amount of time which my team has to spend on the GST compliance of India is around exponential. So if one person has to spend entire time, 60% of his time alone goes on the India GST compliances, and in 40% of his time, he takes care of rest 17 countries. So you can see that what kind of atmosphere the government is creating in terms of compliance for the compliant person, I would say, not only taxpayers. So more a person is doing the compliance, more the burden is being put on those taxpayers who are more compliant, whether it is from the GST standpoint or it is from the withholding tax standpoint. So the companies or industry, the persons who are in the ambit of TDS, then again the government is coming to them, that's you are making payment to these XYZ more people or more kind of nature of transactions you are doing. So we are casting more responsibility on you so that you take care of more compliance of other people as well, so that other people are more compliant. And what the reward they are getting is, if you are not doing the compliance now, earlier the penalty, the delayed penalty on the TDS front, which we were charging you 100 rupees per day, now with this budget, they have increased that penalty to 500 rupees per day. So that is the reward which the government is giving here. And so no doubt, the budget is a two side of a coin, where one side it's a expenditure, and I would appreciate the government here that they have done wonderful job in creating more and more infrastructure, doing more spending, which a country like India need more, whether it is roadway, highway, trains, or water zones. But the second side of the budget is the collection, the receipts, which is the place where the tax comes. And in spite of India doing so well, where the buoyancy is too much, almost in every segment, whether it's a direct tax, indirect tax, the collection has been like more than 40–50% higher than the estimate. But still, no doubt, the government is doing expenditure, no doubt that they should continue to do the expenditure, but there should be a corresponding benefit being given to the taxpayers who are doing good, and not rewarding in this manner, where the more trust-based or the loss of trust is being shown, I would say, in that manner. If you see the overall way, it's a deficit of trust which the government is showing on the taxpayers. Whether it's from the GST side, unless and until you do the two-way compliance, or the supplier and buyer transaction has to be matching for you to take the credit. And more so, like the Simpy has mentioned, now the restricted credit, that layer has also added, without considering that there could be few transactions, let's say let's say insurance service providing. I am taking a insurance for my employees. And if I am paying insurance, GST on the insurance to the insurance company, then to the extent of I am recovering from the employees, at least that credit I should be allowed to take. That simply cannot be put on the restricted credit zone. So who should decide? It's not the government who should decide what is my restricted unit or restricted credits. It should be on the trust factor based, that a person who is doing the business, that person should decide upon. Again, long-term credit, long-term capital gain. Long-term capital gain, there was, so many people, many investors have been facing this problem, that though the eco space for the startups is being or getting created in India, but who is becoming ultimately beneficiary? Certainly not India. India is becoming like more of offshore center where work is happening in India, and entire ownership of those startups is indirectly being transferred from India to somewhere else. And in spite of a lot of representation to the government, what they have done is they are not losing their string of the purse to be in a more benevolent way. Now what they have done simply to reduce the long-term tax rate on those individuals who are holding the shares, who are ultimately beneficially owning those shares, from effective rate of 28% or 28.5% to around say 24% by reducing the surcharge. And they are saying that they have done a good job. But would that be enough for bringing back those investors into India? I don't know whether this would be sufficient or not. Inflation from the last few years, especially when the job losses were happening a lot, and inflation on the retail segment has been a lot. Even today's article, if you see the consumer segment, there has been a lot of inflation, and due to inflation, though the ultimate volume of those consumer care companies is not increasing, just because of the price increase, their turnover is increasing, and it is pinching to the pockets of those consumers, which are you and me as well. I just want to highlight one more point. Maybe I can take it later. Another factor is 148. I think Sarika has touched based on that. Again, it is a trust-based point, I would say. One side, the government says that we are creating a conducive environment for the business to grow in India, and we are bringing certainty. We are bringing certainty, and we are bringing confidence in the business by having predictability of laws and rules. But where that has gone now, I don't know. Last year, it's only the last year where they have said from 6 years, they will bring down to 3 years, and they will not reopen the assessments beyond 3 years. And they have just added that in few particular cases, only in those cases, they would stretch it to 10 years. Now, in the immediate next year, almost every possible thing which they can do, they are bringing into the zone of 10 years. So what does it mean? Just within 2 years, they are bringing all the transactions, because that is the wording they have used in the memorandum, that any entry, any transaction, any entry or entries, that means any sum of transaction, any entry or entries or sum of those is exceeding 50 lakh rupees, they can open up even after 10 years. So you are not trusting, you're not giving any ecosystem and predictability of the rules which the government is is selling in the world. Another point which in the newspaper has come just a few days back, the India's IT business or the sale of the IT services is exceeding the total sales of, let's say, oil world or like one of the oil selling countries. But in spite of that kind of business, you are not encouraging business to bring more business into India. How do you say that, or what kind of confidence you would create that in the PLI scheme, the more and more business which should come through the PLI scheme, and where you are asking about the semiconductor or more and more production or complex chip companies to come to India, if you are not creating that kind of conducive environment? No doubt on the litigation side, they have taken many steps, and in such a way, in one sense, they are good that they are reducing or they are trying to reducing the litigation. But if you see in the manner they have been done, and there have been quite many aspects in the current budget they have introduced. One is that in the case of reorganization, one is that cess thing, which I think Simpy has taken care, has mentioned that any kind of cess, which was in most of the high courts, they have mentioned that it would be allowed as a deduction. So this is one of the example. I mean to say that in most of the ways that the way clarification has come, it is all pro-revenue. Hardly, I think there's one or two provisions which are going in favor of taxpayers. You're not becoming benevolent. You're not behaving like a big brother. You're all in terms of you come and I will loot you kind of stuff. Don't do business in the country because I just dictate, and probably I'm going more negative here. Anyways, I'm just trying to now focus myself on the two particular provisions which are the government has introduced. Again, through the reducing the litigations. So one particular part is section 263, which they have introduced. Until now, in very few cases, the Commissioner of Income Tax or Principal Commissioner of Income Tax had powers to refer the matter to the transfer pricing officers. So no doubt, whenever the CIT or PCIT had some issues, they were just referring the matter to the AO, and it gives another 1 year time to AO to look into the matter and pass the order in favor of, I mean, as per the guidance of the commissioner. But as soon as he is touching, the assessing officer is touching any provision pertaining to the TPO, then section 92 CA comes up, section 92 CA 4, where section 92 CA says that any TPO order is binding on the assessing officer. He cannot touch it. He cannot amend it. And that was the reason, even though assessing officer was trying to touch, he could not do that, and the taxpayers were simply going to the writ petitions and getting that revisionary power, or getting that reference itself is void. Now with this amendment, now the 263 provisions, apart from AO, the reference has been CIT has been empowered to refer to the TPO as well. So be ready that you can get now, apart from the normal AO matters, now many of the transfer pricing matters, you would also see 263 notices. So generally we see that once the 6 months from the end of the relevant assessment year has gone, probably the assessing officer would not be doing the referral to the TPO. But now, in spite of that time has gone, CIT can do with a reference to the TPO, and that can happen later on. Another point is that happens quite a lot when the reorganization is happening. In my own experience, I have seen that many places I have taken the shelter of those provisions, where one company is merging into the other company, so that business combination or amalgamation happens. So what happens generally, if you go to the High Court, or nowadays we are going to the NCLT, it takes like a minimum 1.5 years while we are filing the applications to the NCLT, and the time the order comes from the NCLT. So let's say the application has been made before the NCLT in December 2017. I'm just taking examples for the better understanding perspective. December 2017, we have made an application before the NCLT with the effective date, or the effective date of the order to be April 17 onwards. That means to say, if the order comes, both the companies would be merging with effect, retrospective effect from April 17 onwards. And this application I'm filing in December 17. Now, the order comes, let's say, after 1 year or 1.5 years. So we'll take both the scenarios now. Let's say the order comes in December 2018. What would happen then? My return for both the companies is already due in, say, September or November 2018. So what I will do is I will file the tax return of both the companies in the individual names without giving effect to the merger. But soon after my filing, next month, I see the order of NCLT coming in my hand, and they have approved my merger of both the companies retrospectively from April 17 onwards. Until now, as soon as I'm filing the return, but I'm getting the order effective from April 17, I may or may not do, but now the law is asking me to revise my tax return, which I have just filed 1 month ago. And they are saying that within 6 months of getting the order, please revise your return, what you have filed. And let's say in this particular case, one side I'm taking the, in place of December 18, I may get the order, let's say in April 2019. In the normal provisions of the law, I cannot revise in 139.5, I can't revise my return. But now with these current provisions or the proposed provisions, I still can revise the return, and AO can use that return only to pass the order. Again, there's one more mischief was there, and that was upheld even till the Supreme Court level, that any order being given in the name of non-existent entity would be a void order. What happens, like in this example, I'll continue my example now. I have made an application in December 17. I got the order in December 18, and the effective date is April 17. Now, I have already filed the tax return of my financial year 16-17, 1 year back. 16-17 return I have already filed. The assessment of that return 16-17, I'm talking everything in the financial year terms. So 16-17 return would be due after the order has come, and the order would also be passed, say, December 19 till December 19. Now, when the AO is passing me the order, generally he cannot pass the order in the merged entity name or in the successor company name, because he has initiated the proceedings in the name of old PAN, the PAN through which I filed my ITR. So that's why when the order he is passing, he is again passing the order in the name of the old or non-existent entity. So every time the taxpayers were taking a plea that you cannot pass the order in the non-existent entity, and most of the courts have upheld that this order itself is void. Now, with the powers of the government has amended section 179. They have amended the section 170 and says that now this in these kind of scenarios, the order passed by the AO will not be void. So I understand in these particular cases where it was a mischief being played by the taxpayer, and it was not exactly the intended way the government wanted to shower their blessings or benevolent provisions they were trying to use, and that's their plan. Probably it's a plug of the loophole, I would say, that they have done it. And but again, they have done it after a long period. Maybe this has been an issue or the loophole, I would say, from a quite long time, which they have plugged it now. Most of the things they are plugging it, yes, but once the gravity of the matter is too large, as like equalization levy, as earlier was mentioned, the industry seeks clarification. Industry looks for simplification, but unless the matter is becoming so grave, so big, the attention of the government is generally not there. And it comes after too long when there's a lot of litigation, and if this can be clarified much earlier, that would be really appreciated at the government level. One more thing which I just want to touch base, one or two more things. The government, from the GST standpoint, has done, as per its assurance given in the past GST Council, that electronic cash ledger, if it is coming in the same pan, they would allow the transfer of the cash from the one registration to the other registration. But if that is the philosophy of the government and they want to really help taxpayer, they could have done that for the credits also. Why a taxpayer having multiple registration has to accumulate a tax credit in the one side, and other side they have to continue to pay taxes? But maybe something's better than nothing, and it's a good starting. Another point which Amit has mentioned earlier against 194, benefit being provided to, say, your agents or your business partners. And let's say one question was asked about one pass was given.
The process taken by the officer should be erroneous and prejudicial. But on the generally on a transfer pricing side, most of the time cases is around what should be the set of the comparable and whether the results are comparable and not those kind of stuff. More on a factual side, and on which department generally takes a good lengthy submissions, discuss all the methodology and everything. So is it that easy for raising all these 263 points matters taking up in the under section 263 that the assessing officer has not done the quality job?
See, as you rightly mentioned, Nitin, the transfer pricing aspect is more of factual. It is all factual driven. What I've seen is there are so many facts and factual details, which sometimes or many of the times TPO either miss or makes certain mistakes, which at that time of the passing the order because what happens, TPO order comes up and it becomes part of the A order. But again, when the taxpayer going to the DRP, that time the TPO has very minimal time to make those changes in its own order. It's a very limited time, and that time the TPO is getting a lot of orders and a lot of changes it has to make, and with those limited period of time, that leaves a lot of scope. And I have seen many times in my own experience, the TPOs makes a lot of factual mistakes in their own order. This generally, if it is in the favor of the taxpayer, nobody highlights that. And that is where there's a matter becomes a matter prejudicial to the revenue. And this has been empowered now to the CIT. Other aspect is, no doubt, only those matters which are prejudicial to the interest of revenue. That means to say it is to a large extent, as my understanding, similar to 148, where the proper reason has to be explained by commissioner because the entire tax law legislature goes on the natural justice premise, and certain proper reasoning has to be given. It cannot be just what he thinks or as per his understanding. So unless a proper reasoning is being given by the CIT for reasoning or for opening the order or initiating 263 in a proper documentary manner, it would be difficult for this matter to be opened up, or even if it is opened up, it would subject to again a lot of litigations.
Means there is one more window open for the litigation side.
I think there was one more query in the chat box about 14A. I think 14A has been clarified in the earlier talk by the panelists that it is now an amendment which is now trying to tax the income, disallow the expenses if you have even not earned exempt income, but certain expenses have been made for earning exempt income. So Amit said that probably this was more often linked to dividend income, which was there in the corporates most of the times, or in the hands of individual. Yet there are certain other examples of exempt income in the terms of real estate investment trusts or certain other kind of trust which are there, from where the dividend can still be earned as an exempt income. So there are still certain portion, but the main point regarding this particular explanation which has been inserted in section 14A is the wording of this particular the language used therein. It says that it shall always be deemed to have been such a scenario, right? So although the amendment has been made prospective, but the kind of language which has been used in the explanation would bring in more litigation in terms of the earlier years, because there will be divergent views of the tribunals and the courts, similar to the case of employee contribution, which was introduced last year, wherein the employee contribution, if not contributed before the due date as prescribed in the relevant act, would now be taxable, and it will not be similar to the provisions of 43B, wherein if you deposit it within the timeline or due date of the return filing, then it can there were case laws which were saying that it is at parity with the 43B payments. So there also the amendment was prospective, but the language used was that it is for clarification of doubts, and it always meant that it was not allowable. And therefore, in the last year, there have been divergent judicial precedents wherein some tribunals have held that this amendment is retrospective, wherein some other tribunals and SMC bench of Delhi has held that this is a prospective amendment. So similarly, in this kind of 14A amendment, the language could have been much more prudent. If you are trying to remove the litigations and if you are trying to settle down a particular issue, probably either you bring it retrospectively so that it is very much clear to all. There should be no room for litigation left, right? Just like in the terms of education says, you have brought in a retrospective amendment from 2005. Now all the cases rest. Similarly, if you had to bring in this particular amendment, you could have brought it with retrospective amendment, but retrospective effect, but now the amendment is prospective, but the language suggests that's retrospective. So these are the kind of issues which industry is going to face, and predominantly those kind of industries wherein a lot of investments have been made in subsidiaries or in any other companies, and also the kind of clarifications which were required on equalization levy. So those have not come. So I think the budget, the direct tax proposals are quite skewed in the favor of revenue as of now, which it seems after reading the fine print. Nitinji, your remarks?
Yeah, correctly said, Anshul. As every panelist is also of the same view that budget is more or less a one-sided, although there are certain number of clarifications, and I believe that there are even some social causes also there when you say Section 80DD relief for differently abled person, or some kind of this COVID relief they have legalized now. But more or less, apart from these 2-3 things, it's more or less on a one-sided story.
Yeah, I think one more important. Sorry to interrupt. One more important amendment is there in terms of Section 37, which says that even if you have violated any law in outside of India and you have paid certain penalty, or if you have paid any compounding fees for any law within India or outside of India, those kind of compounding fees and penalty paid outside India will also be disallowed and will be considered as violation of law. So ultimately, if a corporate is opening industry outside of India, is opening subsidiary, or is implementing any projects outside of India, and if they have to bear certain penalties out there, they will not be now allowed as legitimate business expenditure. Also, many times in FDI compliance, in FEMA compliance, there are the compounding fees which we have paid, right? In some other GST laws or another tax laws, there are provision for getting your offense compounded by paying a fee. Earlier, that fee was being claimed as a deductible expenditure because that was not a penalty being paid under any law. But now the government, by amending Section 37, has provided that these will also be treated at par with penalties and will not be allowed as deductible expenditure. So that is also one major area where corporate, because many times these defaults are occurring because of the complexity of law and lack of understanding of those complex laws, right? That therefore the industry goes and voluntarily offers for compounding of that particular offense. Now, if we are not allowing the compounding fee also as a deductible expenditure, that is going to hamper, or it's a hard burn for the industry.
Yeah, basically, when it's come to compounding, and Ashutosh touched the point, it's a trust factor. So if an industry is coming and asking for a compounding and agreeing or accepting that due to complex or whatever the reason, there is something missed out, then rather accepting this apology as such, treating them those, no, it's a violation of law and I'm not going to bear it. So no doubt that's something hit for industry. Yeah, and coming to back on this, when we say the compliance burden, as all of you have pointed out, I would like Amit, in case you can just touch upon that on this 194R TDS on these benefits. Then what do you think that now what industry need to do, or what a company should do to take care of all those kind of things so that there one can be a compliant on those parts?
Yeah, so Nitin, I think first of all, internal evaluation is very much important now for all the companies, because I see most of the companies are giving to the business partners or to the dealers various benefits, which are maybe in the nature of it's generally in the nature of non-monetary, because monetary no one will opt to give, but it's more on a non-monetary option. So we need to evaluate internally what all the you are giving the benefits or the perquisite to your business partner. And second thing is the communications which you need to make to your all the stakeholders, that this is a new law, and this is a new law for the compliance purposes. We need to do the TDS deduction, and it's actually on a very case-to-case basis, because you can't expect a company like a big size to go to the 2,000, 3,000, 5,000, or maybe 10,000 dealers and then agree. So some will agree, some will not agree. And then I think most of the cases, the cost will come to the company only, that I mentioned earlier also, because the grossing up need to be done somehow in the company's hand. And but before doing that, a communication, I think internal evaluation need to be done on all the perks, all the benefits which are given, whether they are perks or, like, say, I take an example of an outside India conference. If I take my dealers to an outside India conference, so whether it's a perquisite or whether it's not a perquisite, because this is a general typical example which happen in a company, because they do take on the conferences and the name is mentioned as sales conference, but we know that the benefits somehow are passes to for a foreign tour to a business partners and all those things. So this type of litigation and this type of issue will definitely come up in the future, and I think it's very litigative as of now, and the company is trying to understand the internal evaluations and discussion with the sales team, with the commercial team, or with the whomsoever the related person. Then maybe a policy will be framed. The good point is that this amendment is applicable from 1st June or 1st July, I think. So we have sufficient time. I think it's not like that we are running off the train and the time is not there. So maybe in some time when we got some clarity, we will see how to take it forward.
I mean, just one question here. So what do you think could be a reason for companies, like most of the companies does this kind of thing, but most of these companies are giving not in cash things. So what could be the reason for the companies giving benefits or not cash and giving gifts, etc.? Is it not to kind of from the tax perspective alone?
No, it's not actually. Ashutosh, I don't see any reason from tax perspective, because this is a general practice. You buy a gold coin, or you buy a watch, you buy a phone, and all those schemes are launched that way, because generally on a P2P transaction, cash doesn't happen, or the sale after sales transaction. It's if you do like that way, so they maybe have other implication, like you are giving a sales discount or you are giving an incentive. So incentive, when I read incentive, is generally given in non-monetary basis. And as per my experience, I don't see many of the companies are giving the incentive in the form of cash. So it's not for the tax planning or something like that, but it's generally the practice which is happening, because when you see you got a gift from like a mobile phone, or you got a gift for a pass, or so generally you are more happy than getting cash in your account, because you know it's my business is happening. I'm daily getting the cash credit, or I'm paying. So what is the much difference? Like I take your example. So we are all employees and we are working in a company. So supposedly on one good day, our company has gifted a gift to all of us. So you will feel more privileged.
From the employees, there's no respite, always taxable.
No, that I understand. But what example I'm giving, that instead of giving a card to you for a 2,000 or 4,000, and if they give you like a gift, so you will be more happy. So it's like sentiment based, which is happening in the past.
I also agree with what Amit is saying. It's more of a customary thing that has been going on for many years, that the commercially that they feel that if they're receiving some gift or in kind, they feel more sort of valued or happy about it. It's
actually the point which I mentioned earlier also, that 147 assessment, I also see a risk for those dealer in hand, because now the department will ask them that why you have not offered tax in the earlier year, and you have the contract, or you are occasionally receiving or most frequently receiving the gift from the company. That means you are a big person. So now come and pay the taxes to us. So I think that is a good move. And earlier, what we are always discussing, that only two people in India are paying taxes. One are the salaried class and one is the big corporate. The other type of people are not paying so much taxes comparison to the other the corporates or to the salaried class person. So now by bringing these type of provision, government is actually bringing more and more person in the tax ambit. That is actually very welcome move, which I understood. But it is increasing somehow on the compliance on the, as you mentioned also, on the compliance on the company side. And the TDS is like a compliance that I need to gross up on, I need to collect, then I have to report in 26Q on the quarterly basis. all those things will happen. Instead of that SFT transaction, I think SFT mode can be very much adopted in this case. That is very feasible also.
Thanks, Amit and Ashutosh and Sarika for pitching. Basically, what to sum up is that kind of thing, one need to evaluate his business promotional policies, that how they are going to be incentivize their dealers and the customer going forward, and how to report that. That's a great to understand from you guys. Anshul, do you have any other question from any participants or?
I think not a question, but an observation that politicians, shawls and other gifts received during their visits should also be brought under 194R. It should not be just limited to business perquisites.
Yeah, so, in case the person who is giving these gifts is reported in their tedious return,
yes,
that may come into that net as well.
Yes.
And as the Sarika and others said, that it's a customary. When you receive a gift, it gives you something more, a feeler more than money. So that's that customary and has to be there.
I think for 194R, there will be many companies or industry players who will be rethinking about the benefits which are being given, and probably they will be where the goods are involved or where the services are involved. Probably some kind of discounts might be brought in place of these kind of benefits or perquisites, and then probably the industry may ask them to pay directly, right?
It
because ultimately
of change in practice now.
Yeah, because ultimately the industry has to think about it. It's not that because it puts on a lot of burden also in order to comply with these provisions. It's not just complying, although the tax base needs to be increased, but how and at what cost it needs to be increased, right? Because the industry is going to incur a lot of cost.
Anshul, more than the compliance burden, I would say, earlier in case of like Amit, the dealers were more encouraged to take those gifts because they were also not giving tax. The company is also not deducting. So it's kind of free buys. Now, since it is taxable, then they will mind it and pay, because as soon as the company is showing that as a tedious return, they say that better I take cash than the gift.
No, in fact, even if you are giving cash, probably that might also get into some kind of tax bracket or some kind of tax net, because TDS is going to be deducted. Ultimately, if you are going to pay cash, it has to be under some head, right? Yep. So that also needs to be evaluated whether tax would apply on those particular cash incentives or not. However, if you are a sales dealer and you are purchasing goods from me, then probably rather than giving a benefit, I can give you a discount what I can say, turnover discount, a volume discount. So those kind of things will need to be thought over by the industry players, by the industry people, and also you need to take sales people into account, because ultimately it's a business thing. The sales people will say that no boss, nothing doing, you have to bear it, The tax comes a little we tax means the tax people kind of tend to suggest, but sales people generally say that boss, this is not going to work in the market. So that is also, we need to take stakeholders on board. The things are getting murkier and a lot more cost, having a lot of more cost in order to comply with these kind of provisions, because ultimately what will happen is there will be certain kind of benefits which are going to be passed on, but how to allocate them? There can be some collective tour packages which are booked, then how to allocate them over individuals, then to book their entries into the books of accounts, because ultimately when there is a payment going from your bank account to the travel agent, you have already deducted tax on under 194C, right, to that travel agent generally on some part of commission. But then the same transaction is going to be subjected to TDS twice. Now, how are you going to showcase that particular amount, because there is no cash payment being made from your side to the dealer or to the vendor which you are dealing with. So that is also an issue, that how are you going to record that TDS in your books of accounts? Probably not many people have given a thought on this particular aspect, but that is a very big issue, because the transaction is between the travel agent and you. Then how come the other party, the dealer, will come into picture, and how will you record it in your books of accounts? So that is also going to create a lot of tax accounting issues, right? So apart from just tax costs, there are a lot of other issues which are there in this budget. Obviously, they have tried to rigorously increase the tax base, but the cost on the industry is going to be huge. So let's see how it turns out, and we hope that litigation should go down, but I don't feel so. And the business and the jobs of tax professionals is being kept safe by the government. That's what I can say as my concluding remark. So should we conclude, Nitin ji? We are already, it's a lengthy discussion which we had today, and thanks for all the participants.
Rather lengthy, I think it's a kind of fruitful discussions, detailed discussions. Every participants panelists have explained it thoroughly, that what's there in budget and what is the implications. So I think there is nothing, in case anybody want to add something, otherwise we can conclude it.
Yeah, Sandeep ji, if you want to have any concluding remarks, we will be more than pleased to hear you.
No. Basically, it's a healthy discussion regarding current tax regime. So basically, just like conclude, तो आप लोग ही कर चुके हो. So further, just thanks for inviting me in this session, and such a valuable discussion you all have in different industries, and this is a very good platform. Just like first time I have joined, and it's just Anshul and I have a good friend from last around 15 years back, but
almost 20 years now, Sandeep.
Yeah, it's around 20. But I have joined in this session, this group from first time. So next I will try to join in every sessions next during the period.
Sure.
Thank you.
Thanks, Nitin.
Yeah, thank you.
Thank you.
Yeah, thanks.
Thank you, everyone. Thank you.
Thank you.
Thank you everyone for
Thanks
joining in. We are formally concluding this session, and this session will be made live, will be uploaded on YouTube also for future references.
Yeah.
So if you have missed it, some part of it, you can have a view at later on. Thank you everyone. Thanks
Thank you.
to all the panelists. Bye.
Thank you everyone. Bye.